Hey everybody, hey traders, Chris Pulver here. Just before 1 p.m. Eastern Time on Monday, September 1st. Happy Labor Day. U.S. holiday, markets are closed, and we do have a good week ahead though. I wanted to bring up a couple things. So looking at the Edge Finder tool, let me get this down here. There we go. NASDAQ seasonality as well as S&P seasonality. We have gone straight up for the most part since the bottom in April. So May's rally, June, July, even into August, we finished nearly 3% in August. We've had a heck of a recovery since the bottom in April. September, October, usually the weakest part of the year seasonality-wise in the NASDAQ. You can see here, average for the last 10 years is down 1%. Certainly that means there could be more volatility ahead. We could still have that like average close, maybe at negative 1%. It could be positive as well, but I would expect to see some corrections coming in September. Whether it's a bit of a bummer this Friday with non-farm payroll, or we have higher inflation readings, or the Fed starts to cut and investors realize that the long end of the curve is not going to be changing too much. But this is what the seasonality looks like. We can get through a rough patch here, September, October, as long as we don't have, I would say, a steep correction. I really don't think the market can handle a 10, 12, 15% correction and immediately bounce back to the all-time highs. I think if we have like single digits, if we're going to be down, let's say, 5%, maybe 5 to 8%, something along those lines, or we bounce aggressively right at that 10 number. We'll see if we get back and fight back for a finish of Q4 to be pretty strong. So September not looking good seasonality wise. Go into NASDAQ as well as S&P. You can see they're both pretty weak windows. Here is September average over the last 10 years down over 1%. October also pretty weak. And then Q4, we lift some animal spirits to finish out the year, November and December, and see if that can carry on to the end of the year. So that being said, where are we at? I have a couple of technical patterns as well as some levels to watch. That would entail a rising wedge pattern, which looks something like this. If you take this low, connect the dots, or you can even take this low and connect the dots. They're pretty much the same line, okay? Now take this recent high, like so. So to me, if this is going to be 1, 2, 3, 4, 5, this could be a 3-drive pattern that makes its way lower. If we break out of this rising wedge, this would be my first target for the bears. And that is coming back in right in line with the previous all-time high. The second target would be either this low or this low, because this is essentially where the wedge started. We have support, we have support, we have support. If support is breaking, this is a correction area between about 6,200 and let's say 6,000. And if it gets a little bit more dynamic, pulling back into like the 144, the 200 moving average, now we're talking 6,000, possibly down to like 5,800. That's going to get a little bit scarier if it comes back down to 5,800. But if we make a move towards moving average, lower high, moving averages, you want to see this market, maybe finish out here with a correction. If we have a 1, 2, 3, 4, 5-wave correction, then we start to work our way back up into these recent highs again. Scooping up, playing the options game, looking at investing, reestablishing core positions, deploying capital. I mean, I've been sitting about 45-50% cash these last couple months, just enjoying this melt up to all-time highs. But I am a little cautious moving forward. So, I mean, part of it's just purely technical. We should pull back to this 50-day moving average. We haven't closed. We haven't closed below. I mean, this was a 1 day that we closed below, and the rest of the streak was after the U.S.-China trade agreement gap. So we've had a heck of a run where we had so many days in ahead of the 21-day moving average. We've had so many bars where we haven't come back to even touch the 50-day moving average, and the distance away from the 50-day, the distance away from the 200-day. These are all kind of out there historically as some pretty high overstretched levels. You get into some of the other, technicals. I'll bring up one of my charts here. This is my harmonics and pivots where I show relative strength. So right here, let's go to the SPY or SPX. I've got my subgraphs. What you're noticing is price. This is on a daily time frame. Okay, price is making higher highs, but you can see pretty obvious disagreement. Price is making highs, price is making highs, price is making highs. You're seeing a disagreement in relative strength and momentum, like so. So we do have some overbought conditions as well as divergence. That's in the S&P on the daily. You can go to the QQQ for the NASDAQ and see something very similar. You can see that we're making higher highs. We have not made a third high though. We've had a 1, 2, 3, 4. We haven't quite made a higher high in the Qs. But if we end up breaking this could be a little bit of a head and shoulders pattern to break back down, find some dynamic support. We have previous all-time highs, find that 50-day moving average, things like that. You look at your divergence, okay? Price making higher highs, disagreeing with momentum, price making higher highs, and strong bearish divergence on the relative strength. So this price divergence and momentum, it usually ends up being a pretty good, reliable indicator on the daily time frame. Especially, it takes a lot to get into an overbought condition. It takes a lot for the market to roll over on itself. You go to the weekly time frame. Okay, we've had one heck of a stretch on the weekly, but what is interesting is how much this momentum just turned at the top. And even though we're not quite at overbought conditions on the weekly chart, we are still seeing inside of this that price has been making higher highs and relative strength has been disagreeing.
With Pulver Alerts, you get access to the complete log of all of Chris Pulver's trades. But who is Chris Pulver? Chris has over 20 years of trading experience and he's a licensed money manager. He trades all aspects of the market, including Forex, stocks, ETFs and futures, crypto, commodities, and just about everything else. Let's talk more about where you can find these trades. Inside of the A1 Trading Discord, on the left-hand side, you'll find Chris's section. It's broken up into different categories to make it easier to find the trades you're most interested in. Here, you can browse his trading journal, where he shares videos and general market analysis, his indice trades, commodity trades, Forex, stock and options, and his futures trades. All trades come with analysis, including entries and exits, risk to reward, and more. We're very excited for the future of Pulver Alerts, and we hope you are too.
So on the daily and weekly, I think minimum on the S&P and the NASDAQ, we're likely going to have some pullbacks. Okay, so where to? Well, QQQ, very similar on the daily time frame. Look at the 50-day moving average. This is an EMA that I have in my chart. This chart's a little bit messy, so let me go back to this. So QQQ. So SPX pulling back towards 50-day moving average, which is 6,300. It's not that big of a correction. Just so you know, it's going to be maybe about 3% off the recent all-time highs. That's 3.07. That's about the same type of correction we had here from July 31st to August 1st. It was like 3.3%. So if we have a 3% correction, okay. If we pull back a little bit deeper, let's say we go down to the 50, lower high, lower low, we pull back to previous all-time highs, there's plenty of support in here to find some buy levels. Okay, go to the NASDAQ. 50-day moving average is around 559. Previous all-time highs of 541. Pull back into some of these Fibonacci levels, retracement levels. 540, 530. This is 529. 514. At the very least, a pullback to the 50-day. If we go head and shoulders, so this is a shoulder, head to neckline. If we break, we can look at symmetry in here, maybe a rejection, and then another fall until this trend line kind of troughs out. Okay, so dynamic support in here on the NASDAQ between about 550 and 520. Pretty good support in this area to start looking for some bounces. I will probably position myself on the Pulver Alerts for some really wide forgiveness by trading some options where I can get prices way down here and generate some income. If the volatility index goes up, so if VIX rallies because the markets are falling, I plan to sell some more premium and try to sell premium with strike levels that are way out here, way out of the distance. Okay. All right. So that's just correction levels. If we go to the Dow has been hanging out near these all-time highs. This was I think this is Jackson Hole. If I'm not mistaken, maybe that was Jackson Hole where we pushed to all-time highs. And I'm pretty sure that was. Yeah, that would have been Friday the 22nd, which is Jackson Hole. So the Dow pushed to all-time highs. We're still hanging out right there. This is another one that we've gone a long ways above the 50-day moving average. Okay, we also broke recent all-time highs. If I drag a swing, 1, 2, 3, 4, 5, I think we at least have an ABC correction. So some type of ABC correction could be right back into the same area before the market finds support, go back up to the highs again, possibly higher highs. I still believe the market's capable of higher highs. I know that Lots of people are worried about this. The U.S. labor market's going to roll into a recession. Things are going to slow down. It's all to be determined. We've had some of the biggest left tail and right tail forecasts in these markets that I have ever seen in my career. That just means deploy the type of strategies where you have risk management under control. Deploy the type of strategies where you have a lot of forgiveness, and be tight with your stop loss. If you're wrong, be wrong quick. If you're right, ride your winners. But we've had some incredible runs since the bottom in April. There's been plenty of buying opportunities on a lot of things, not just in currencies, not just in futures, but also in stocks and indexes. So, Dow, if we roll over in the S&P and we roll over in the NASDAQ, I'm sure the Dow's going to pull back as well. Expect some higher volatility in the Russell. Although it has been outperforming, Russell had a fantastic August. August was up, I want to say, close to 8%. I think it held to those gains. So looking at the open of August on IWM, we were 8.7% from open to close. That's pretty impressive. We got up as high as 9.6%. We faded a little bit on Friday. But wow, what a great run, and just totally crushed the other indexes. SPY did not do anywhere close to that. NASDAQ did not do anywhere close to that. Go to the monthlies on the SPY, this tiny little green candle, maybe 2%. That was a run of 3% in the SPY. The NASDAQ, a little bit more of the wick to the upside, smaller body to trade. Also, interesting, I'm showing monthly divergence. Wow. Monthly divergence on the NASDAQ. Qs were up about 1.8%, 1.9%. And the Dow faring a little bit better, certainly looking more green with more body. This was up around 4%. So Russell, top performer at over 8+%. Dow in second place at 4%. SPY or S&P at 3%. And the NASDAQ at 1.8, sub 2%. So I think, if anything, this is telling us that the rotation is underway. We have a pretty strong rotation, and again, it's not like money is leaving the stock market. It's just getting rotated into things that are a little bit better value. If you're looking at sectors, you can go into what is performing well these last 5 days or so. Okay, what's performing well? Energy had a huge bump. Financial still nice and steady. Technology, I'm surprised technology is not more red. Consumer staples come down a big way. Utilities down in an interesting way. I still think those are pretty good bullish positions. Utilities is super boring, but a lot of them are dividend based, and they've had a great run. So it's way less volatile in utilities than it is in tech. I think, if anything, this rotation that we're going to see is rotation into good performing, good fundamental, small and mid cap stocks. The Russell 2000, it's 2,000 stocks. It's a lot. I think you're probably better off with an S&P 600 or an S&P 400. Take the mid caps or take the small caps and see which ones are performing better. The Russell at 2,000 companies, you probably have about 30 to 40% of them doing well, and well enough to benefit from rate cuts, and maybe also just the catch-up trade where it's been large caps outperforming for such a long time. Small caps have this opportunity to catch up. So I did build a workspace out this week, and I shared this in a couple of sessions. Let me go into blank 2, and this is comparing the S&P with the Russell, with the NASDAQ, with the Dow. And I'm going to go since the bottom of COVID. This is our COVID low here. And just the comparison of all of these major indexes. Okay, percentage-wise, let's go. Let me zoom out. There we go. So I'll start from COVID. Roughly there. Okay, so this is the NASDAQ at 196%. This is from the COVID bottom, okay? Then you have the S&P, then you have the Dow and the Russell. This catch-up trade, this rotation that I'm talking about is, let's say that the S&P just goes sideways, okay? Or let's say that it goes a little bit higher, but just slowly higher. So let's say the angle, the trajectory of the S&P is something like this. Let's say the NASDAQ possibly gives back some. It's certainly more volatile than others, but it gives back some, or still stays relatively resilient, but does a slower trajectory growth. So that type of gain compared to the Russell having a faster gain, possibly the Dow having a faster gain. This is the small caps closing the gap on the large caps. I keep saying this. This is what we saw back in March and April of this year. The market can broaden 2 ways. It can broaden out with everything performing well, but that is underperforming, i.e. the Russell, performs better faster and it catches up. Or the S&P rolls over, the NASDAQ rolls over, and the Russell maybe just rolls over a little bit. So less of a lagging performance, less of a down performance versus the S&P and the NASDAQ being a little bit more top heavy and concentrated. Okay, that also is a way for the market to broaden. I think all in all, I think the markets are still pretty darn bullish. I don't think there's going to be any major break to the markets until we see potentially a big policy shift come, fall of 2026 with the midterms. I think the U.S. is still like all systems go. You're trying to grow. The Fed is now at that point where it's going to start cutting rates. Historically, when the Fed is cutting rates near all-time highs, it's usually signs of slowing. It's not a good sign typically, as opposed to the Fed cutting when we're at weaker times and the market's already down, because that would be the sign of kind of troughing out. But when we're sitting here at these highs, it historically doesn't do well. Plus, we're at these high enough valuations where I could see there being lackluster returns or a fair amount of volatility. Remember, you can still make good gains if you've had this reflexive rally, you've got a lot of gains, as long as you're not giving it back. This is why I'm trading with such wide margin for error. As long as the market doesn't come down and break April lows, I'm going to be fine. I do have hedges in that zone that would pay me. I just did one last week that pays 20 to 1 if I need it. And I have one that pays over 40 to 1 if I need it. So I do have some, insurance that goes out to December, January of 2020. It's December this year, January 2026. But I certainly don't want to see the markets go all the way back down to April lows. So even if we pull back to recent all-time highs, let's say we have like a 20 to 30, it's not a percent correction. I'm using the wrong term here. But if you take a low to a high, it's just a percent retracement. Okay, as in like a fib retracement. It's not a percent off the market. That'd be a huge correction. So what I mean by that is this: if you go back to the daily time frame, you drag a fib from the April low to these recent highs. I'm just looking for any meaningful pullback. SPX, you can already see that I have it up here. So there's my high. Okay, so this kind of convergence of indicators between hitting the 50-day, hitting previous all-time highs, how does this align with some of these Fibonacci levels? Well, the previous all-time high is right around this 23% fib. That to me is a good technical spot. Between 23 and 38%, somewhere in here, I could see the market offering a lot of good support to get back to these highs. So if we have the VIX rallying and the markets are falling, I will be selling premium puts way down here to hopefully get myself for forgiveness. And if the market wants to stall in here and fight around a little bit, make its way back to highs, that's just more income that I can make here for the pulver alerts. Okay, let's switch gears, talk currencies. I think I beat that up enough technically. So I'm expecting September with the Edge Finder showing some seasonality. September is one of the worst performing months, if not the worst performing months the last 10 years. And usually the seasonality windows that look pretty weak in the markets would be a February to April, which you saw that again this year, and a August through October. And August was a decent month. So September usually is bringing on a bit of pain, a bit of a correction, maybe a pullback. And, with the Fed cutting, we've got the labor market with non-farm payroll and inflation data coming again. We will see how it all kind of plays out with price action. All right. So dollar index, I think that if we get a bit of a risk off play, then the dollar index is probably coming back up into this 100 area, maybe higher. This also gives the bond market a chance to give some short-term pops. Everyone's been talking so much crap about bonds and how bad they are, me included. I literally do not want bonds in my portfolio, but I do have exposure to TLT. Okay. Now, the reason I have exposure is because it does yield nearly 4%. The only issue is I don't know if this low is necessarily safe. I could see the bond market do something like it did here. It comes back up to what looks to be a buy zone, but it's not enough to sustain. We're not going to see any major crossover. So you're not going to see the 144 or the 100 or the 50 crossing above the 200. Instead, what you have is you'll have price closing above and then price closing back below. That's going to be a top, and we come right back down to the bottom. But that offers a bit of a relief to the upside where bonds can rally off these lows, maybe get some investors excited, or at least make it feel like, hey, my safe haven trade is working. It's offsetting some volatility because bonds are doing their job. They're cushioning some of that volatility that we might be seeing in the equities market. Well, I think that's fine, but I think it's also short-lived, and bonds likely come back down. So if I can get out of my bond position, I do have some diagonal spreads on TLT. I've got a sell call at 89. If it's above 89 and I get this called away for profit, I've got about 25K in profit on TLT. I want to let that go, and I want to take that 25K and allocate that to a split between gold, silver, and Bitcoin. Okay? So I'm trying to actively get out of TLT and put that into gold, silver, and Bitcoin. But I'll manage it for right now, and I'll manage it to the best of my ability until I get out of that trade with some profit. But a bid on the TLT, a bid on the dollar, I think we have some risk-off trading underway. And if we get it, let's see if the bond market can come up here and have bonds actually go up, that would bring yields down a little bit lower. So if you're looking at the 10-year yield, does the 10-year yield actually tap some of my chart alarms? We have Liberation Day lows when the markets were tanking. We did see a sub 4% 10-year. The issue with that is that the market was so uncertain that spreads were widening as that happened. So if we start to see the 10-year yield going a little bit lower, that's probably a good sign. The one thing to watch on this chart, this is US 10-year. So US 10Y is the US 10-year yield. The reason this is important to watch is because when the Fed starts to cut, what is the instant reaction of this chart? Because if the Fed starts to cut and we see this type of move from low to high, that is not good. Because the Fed is looking at cutting anywhere between 1% and 1.25% by the end of 2026. If they cut 100 basis points, 125 basis points, and this yield goes up by 100 basis points or up 100, that's not good. That's exactly what happened in September of last year. So despite the Fed being down 100 basis points, this market rallied 117 basis points. The total opposite of what it's been doing for 40 years. So if that were to happen again, this is going to be a very sad picture for investors to think that my mortgage can be cheaper, rates will be lower, I can borrow, I can restructure my debt. It's not going to be the same. So unfortunately, I don't think that yields are really going to come down in a meaningful way. I don't know how bad that is for the market, because if it doesn't really change, I mean, look, the market's clearly operated this far with nothing happening. We haven't really seen improvements in yields. You can see that we've had yields be pretty much stuck between 4.1, 4.4%. Well, if it does the same thing again, okay, the market can operate in here. It's not going to be fun. It's not going to be pretty. It's not going to be a huge improvement, but at least nothing is breaking. I think the concern would be a monster rout in yields, either an aggressive change to the upside, which would scare everybody, or even aggressive changes to the downside. You don't want to see these drastic swings in a $50 trillion bond market. Okay, what you want to see is something pretty steady. So yes, the Fed has been dripping this transparent, rate cut cycle for a while. I think Jackson Hole is pretty much all cemented. If you look at the Fed Watch tool, it's like an 87% probability right now that 90% chance that the Fed is going to be cutting. Okay, so there's your rate cut likely coming in September, and another one looking to cut. It's very close between October. It's 47 for a no cut, and it's 48 for a cut. So we could have, a cut in September and then a cut in December. We could have a cut in September, October, and December. This again is subject to change, but 1, 2, 3, 4. Right now, this is showing 5. So from September to the end of 2026, 5 cuts. Okay, 5 cuts at 25 basis points. That's why I said the Fed is looking for about 125 basis points of improvement. Now, does that improve borrowing rates? In the long end of the curve, it might not change that much. On the short end of the curve, it might, right? But not many people are borrowing, 1 year out, 2 years out. Most people are borrowing 5 and 10 years out. So this remains a very complex situation in the next 12 to 24 months. This is why I think the midterms in 2026 will be so important. If people are unhappy with how things are going, the one way they can fight back is vote on it. And I don't personally, I'm not political. I'm a pure centrist. I want to trade the markets and not be bothered by politics. But if the pendulum shifts from one extreme to the other extreme, I don't think that's good either. So unfortunately, there's not really a common ground. There's not really a middle ground. I just don't know what that's going to mean. But I do think that the runway for this environment with this administration that's pro-growth regulation, we're kind of dealing with the tariff situation as it unfolds. It's still just up in the air with how effective it's going to be, and if it ultimately has costs that are passed on to consumers. We don't know this yet. Okay, so pure trading wise, I'll go back and simplify my entire outlook with this. Pure trading wise, I am looking for deployment of capital with the most forgiveness possible. Okay, so if we see a drop in the S&P, a drop in the NASDAQ, a drop in the Dow, a drop in the Russell, I expect the dollar to catch a bit of a bid. I think that dollar index goes higher. I still think this is something I can fade. So if the dollar goes up, I'd be looking for trades like the euro dollar to hit some recent highs and possibly fade, or just kind of break out of this little sideways range. If we go sideways, make sure you don't, watch out for price manipulation here. It might poke the highs, hit resistance, and then sell off harder, but that would be dollar catching a bid. If we fall back into dynamic support levels, here's a 100, 144, and 200 moving average. I like these buying levels to be buying at like 113, 112, and then trying to get back to 118. If we go back higher than that, maybe a 120. maybe a 120 move on the euro dollar could be seen if the dollar index is going to see fresh lows. So there's opportunities there. I think if we have a short-term pop in dollar strength, I think if we have a short-term pop in bonds, if we have a dip in equities, if we look at the volatility index that's sitting around 16, if we have another flush up to like 20 to 25, maybe even up to 30. I don't think we're going to have another big 40 to 50 to 60 VIX. I think we'd have maybe a spike up into like the 20s and 30s, just like we had here. This was a little bit of a flash move during December of last year, and then another one in March before things got really crazy during Liberation Day. But a spike up into the 20s is fine, but I think naturally like that 20 to 30 level offers a chance to, buy a dip position for hopefully some good premium at that time. And that's pretty much my plan, is a wide margin for error, deploying some capital on discounts, a slightly higher volatility here through the month of September. I think September, October could be a needed correction. We haven't really had anything meaningful since, I don't even know if this is correction. This is just pure volatility. We obviously had our Liberation Day lows. We had a pullback here that was just a technical move. It was a cup and handle pattern because there's no left structure, and it blew the top off of 5,500, and it hasn't looked back ever since. We've hit symmetry. We've hit all my measure moves, right? If I go cup and handle, there's my measure move. There's my measure move. We never stopped. We paused right there, and we just kept going. There's your ceasefire, pausing. So anyway, all I see is a 3-drive pattern. If we have a 3-drive pattern, that is 1, 2, 3, 4, 5. If this structure breaks, we're going to have a correction. Pullback level. Look at your Fibonacci levels as well. We'll see how it plays out. Okay. So a lot's up in the air. I'm expecting some volatility ahead. It's not a bad thing, but strategies I'll be deploying for pulver alerts will be wide margin for error. I'm going to be picking my currency trades really, really carefully. I think I'll be dollar cost averaging to some. I still like my Aussie CAD long, my New Zealand CAD long. I'm still watching Aussie New Zealand as well. Aussie dollar, New Zealand dollar. The yen cross, I think, still watching this big opportunity on the dollar yen or the Swiss yen. Nothing's really happened yet, but looking at something like Swiss yen, if it's ready for a bearish pattern, a break of this trend line, a retest of this, I love that sell trade, and then down we go for a trend. If that sets up, we can go above the high, have potentially, almost 2,000 pips worth of opportunity. If this is a yen basket trade, that could be pretty exciting in currencies. If it's a Swiss basket trade, that could be really exciting in currencies as well. So part of me hopes that it's mostly the Swiss that does that type of move, not the yen. But I want to make sure that I'm on the right side of that trade. I do have some exposure on the Swiss pairs. I'm still long on Aussie Swiss. I'm still long on CAD Swiss, which has still refused to make a decent bottom. Euro Swiss has been better off the lows at 92. Pound Swiss is doing better off the lows at 107. New Zealand Swiss is doing better. New Zealand Swiss right here. New Zealand Swiss, coming back into same lows. If we can break above some of these moving averages, we just need to shift the corner. If this is a low that's going to hold, can we have a double bottom from this nearly 4,700 low back up to 500 or 5,000? That's a 300 pip potential pattern. So if we have 300 pips back to the center high, another 300 pips to measure this move, that puts us up into like 53 to 5,400. If we can hold this low, break this center high, I'd be looking to take profit on New Zealand Swiss up to like 52, 5,300. Just measuring it out. And then dollar Swiss looking a little bit better on the right-hand side of the trend line, watching to see how this pattern plays out. If this is a low, or maybe the back side of the trend line hits a slightly lower low and reverses here, I'm looking for like a 3 to 5 wave move. This is a nice inefficiency that I'm trading back on dollar Swiss as well. So between 86 and 88, that's a big profit target for me. I've just been dollar cost averaging in at these lows, breaking on trend lines, just average back in on dollar Swiss for a little bit longer. But getting back to 86, 87, 88, big profit target there. So again, lots to trade, lots to be watching, and alerts will be flowing here in the next week or two. So stay posted, stay tuned. If you have any questions, you know where to find me. Let me know how I can help. Happy trading, lots of profits. Talk to you soon. Bye.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button, or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.